All right, welcome to The Explainer. Today, we're going to look past all the usual headlines because there are two pretty deep, under-the-radar risks that could, well, completely reshape the financial landscape. Right now, if you turn on any financial news channel, it's just all optimism, right? Everyone is bullish. You've got fund managers talking nonstop about growth prospects, especially in hot sectors like semiconductors. But here's the thing, and history teaches us this over and over. When complacency hits its absolute peak, that's exactly when you need to be paying the most attention. Yeah, exactly. I mean, one of the biggest risks aren't the ones being debated on TV every day. The real dangers, they're almost always the ones brewing just beneath the surface, totally off the radar. So that's what we're going to do. We're going to pull back the curtain on two developing situations that honestly fly in the face of all this bullishness. Okay, so here's the game plan. We're going to talk about a new kind of financial war, then a really surprising weapon that could play a role. After that, we're diving into a strange mystery brewing in the Middle East, and we'll wrap it all up by asking what this might mean for all of us. All right, first up, look. We all know about the US-China conflict. It's been all about tariffs and tech for years. But what if the next battlefield isn't about goods or microchips? What if it's being quietly set up in the financial markets? So here's where it all begins. It's actually a pretty basic economic imbalance. China has this massive surplus of savings, mostly because their internal demand just isn't that strong. All that money, all that excess capital, it has to go somewhere. And when you look around the world, where can you park that kind of cash? There's really only one place that's deep enough and liquid enough to handle it: the US financial markets. It's basically the default destination. Okay, so here's the big what if. What if the US starts looking at this flood of incoming money and decides to treat it just like it treats imported TVs or steel? We saw tariffs on goods, so what's to stop the next move from being a capital tariff, basically a tax on all that foreign investment pouring in? But, it's not that simple. You can't just flip a switch and start taxing capital. Doing that could literally break the entire global payment system. It would be chaos. So to even think about pulling this off, you'd need a totally new kind of financial tool. And this is where it gets really interesting. And here's the core of the problem. The US dollar is trying to do two totally different jobs at the same time. On one hand, it's the world's medium of payment. It's how oil is bought, how goods are settled, all that day-to-day stuff. But on the other hand, it's a store of value. It's the world's reserve asset for major investments. The issue is, how do you tax the investment part without completely wrecking the payment part? They're tangled together. Okay, and this is where an unlikely hero, or maybe villain, depending on your view, enters the picture: stablecoins. Just think of them as digital dollars. That's really it. They're built for one thing: to act as a stable, digital version of a currency that can handle payments and do it instantly and, crucially, separately from the traditional system. So, this lays out the potential strategy perfectly. It's a two-step move. First, you separate those two jobs the dollar is doing. You could, in theory, move all the global payment stuff onto these digital stablecoins, letting them run smoothly without any interference. And then, step two. Once the payment system is safely over here, in its own little sandbox, you're now totally free to go after the other part. You can impose that tax on the old-school, non-digital, asset-based dollar that's used for all those huge foreign investments. Okay, let's shift gears to our second hidden risk. And this one feels more like a detective story. We're talking about a silent liquidity crisis. That's when cash, just plain old dollars, suddenly becomes incredibly hard to find, even for people or countries that seem to have tons of money. So the mystery begins with this really bizarre request. You have a very wealthy Gulf nation, we're talking about the UAE, a country that the IMF just called solid financially. And all of a sudden, they need an emergency dollar rescue from the US Federal Reserve? I mean, that just doesn't add up. It goes against everything we think we know about their financial health. And this is where the plot really thickens. It's not just that they needed money, it's how they got it. They had a really simple, cheap option on the table, what's called a repo loan. All you do is use your US bonds as collateral. Easy. But they didn't do that. Instead, they chose this much more expensive, much more complicated option called a swap line. So the million-dollar question is, why on earth would you choose the more expensive, harder path? Well, when you think about it, there are really only two possible explanations, and they are worlds apart. The first one is just concerning. It means the amount of cash they needed was so unbelievably massive that even all their US bonds weren't enough to back the loan. But the second explanation, that one is truly alarming. What if the US bonds they're supposed to have on their books just aren't there? What if they're gone? So what's the takeaway here? Well, sure, in the short term, the Fed stepping in and pumping cash into the system might even cause the markets to pop. You see that sometimes. But that's not the real story. The real story, the one you need to watch, is that a major global player seems to have run out of options. They've hit a wall and are now completely dependent on a bailout. And think about it. This could explain some of those weird, unexpected drops we've seen in the markets lately, in both stocks and even gold. Maybe it wasn't about recession fears like everyone was saying. Maybe it was just a giant entity being forced to sell anything and everything that was easy to sell just to raise cash. And if that's true, it means they've sold off the easy stuff already. They're now at the very end of their rope. So I'm going to leave you with a final question, a piece of homework, if you will. These kinds of huge liquidity problems, they don't just appear out of nowhere. They often leave footprints in the charts before things really go bad. So do this. Go pull up a chart of the S&P 500 and look closely at the months right before the big crashes in March of 2020 and September of 2022. The patterns are there. They're often visible, but only if you know what you're looking for.